Hey there, folks. This is Mitch Firestone with Precision Trading Labs in New York City. I am here to bring you the market wrap-up for the week ending July 28th, 2023. Here are the three major market indexes, the Nasdaq, the S&P 500, and the Russell 2000, and as well as the TLT, which is the 20-year plus bonds. Here is our reference date for the prior week. So this is the close of the prior week of July 21st, and so this represents the percent change in performance for the week that just concluded, July 28th, that started on the 24th on Monday. So that's what we're looking at here. So here's our zero line here. So we can see, of course, that the Nasdaq was the big winner for the week, up about 2%. The Russell 2000 was and the S&P were up about 1, and we can see that the bonds were down close to 2. For last week, the bonds were kind of exhibiting that traditional inverse correlation with the equity indexes. In connection with that, though, I did want to show you something that's kind of interesting. This is actually a great website here, More Research, MRCI.com, and they actually have this really nice page here, which shows market correlations. And so what you do is you have this grid here, and this is the equity indexes up here. These are the bonds. These are various currencies. These are the metals down here, energy, and it kind of goes from there. Further down, there are agricultural products. And so you got this grid, and then, of course, it goes across with the same symbols. And so you can kind of cross-list what you're looking at here. So in other words, right here, here is the S&P right here. Here's the ES. And if we go across and we look for the TY, that's the 10-year note. Okay, so it's not exactly the same as the TLT, but nonetheless, the bonds are going to, in a sense, they're going to rhyme. And so whatever the 10-year note's going to do, it's going to be somewhat similar to what the TLT is doing. So this thing shows that between the ES and the 10-year note, it says minus 25. So essentially, it's exhibiting what might be considered to be a fairly mild. It's a definite inverse correlation, but it's not a really highly significant inverse correlation as it is shown in other times. In other words, this has been sort of quasi-random, and as well as exhibiting a bunch of positive correlations. Now that's for the last 30 days. Okay, and that's why this website is actually kind of cool, because this is showing this for the last 30 days. However, if we go back, let's say 180 days, and this is also trading days. This is not calendar days. These are trading days. So 180 trading days is going to be approximately what, about like 10 and a half calendar days. So but if we go back here and we look at the same exact data point here where it's showing minus 25, if we go back to this and we go back much further in time, okay, we can see at that point it's minus 46. So it's essentially kind of almost twice the inverse correlation as it was looking at the last 30 days. And then if we go back sort of in the middle and we look at the 90-day mark and we look at that same data point, then we can see it's minus 87. So in a sense, this is a extremely strong inverse correlation based on what the close was on any particular day. So if the bonds were up, the equity indexes were down 87% of the time. That's what this is showing here. On the other hand, for the last 30 days, that same data point is only showing it's down. It's only out of step, 25% of the time. So we can see that 90 trading days ago, it was highly inverse correlated. 180 days ago, it was somewhat inversely, and now for the current state, it's kind of a minor inverse correlation. So it's always useful to kind of keep an eye on that, so that this way, if you're looking for guidance going between the equity indexes and the bonds, you kind of want to know, well, essentially, where are you in time? So this is what we were looking at last week. Okay, so this is the week before, when we can see that the Russell 2000 was up, Qs were down, TLT was here. But again, going back to that correlation thing, if you're going to be looking for some guidance about looking at one versus the other, you kind of want to see what is the state of the world with respect to correlations. So I kind of just gave you a tool to kind of do that. And so if you look in the note window of this presentation, you'll find that I dropped in the link. So I figured I would just share that with you. All right. So at any rate, what we're going to now do, more importantly, is we're going to actually go and look at where some trading levels are for these equity indexes here. Okay. Before I do that, though, of course, the ubiquitous disclaimer: Precision Trading Labs, we are not financial advisors. We are not fiduciaries. We are not broker dealers. But we are simply here to present trading information and education, and in an effort to kind of give you the skills to hopefully become competent traders. So that's our mission here. All right, so let's take a look at the charts here, and we'll see what we have here in terms of some potential trading levels on these equity indexes here. So here's where we closed on Friday, on the 28th here, and this is the daily chart of the S&P 500 ETF, the SPY. All right, so this is what we're looking at here. And so we can see that the close right here was at almost 457. Okay, so that's where it closed that day. And so if I'm looking at this chart here, I'm looking to see, well, where are there potentially long trades or bullish trades, and then where are places that I might be inclined to short or present some other sort of bearish trade. And when I talk about that, I'm talking about essentially how one could express a trade. So at this level down here, where we had a drop and then a base and then a rally up there, this area of consolidation is an area where there was an exhaustion of sellers. The sellers essentially just disappeared after this 3 days of essentially consolidation, and sort of prices being kind of in equilibrium, as it were. And then all of a sudden there was an exhaustion of sellers here, and the buyers ran up the price chart in order to create these trades that went up here. Okay, right here, this is an area of interest where if price returns here, we actually expect to see another round of buying here, and we've referred to that as a demand zone. And the reason for that is supply and demand within this narrow range, they were in balance, and as a result, price kind of more or less stayed in this relatively narrow range. This is about a $3 range out of a $437 instrument. So a $3 range, that's like what, 0.8%, 0.9%. So it's a less than 1% range, and so that's what this basing, this consolidation represents here, an equilibrium between supply and demand. But then that equilibrium gets broken, and the supply, and essentially the supply disappears here. And as a result, in order for these trades to occur, the buyers ran up the price chart until they found willing sellers. When price returns here, we expect to see another round of buying. Okay, if we look over here where price closed, and we look where this level is in relation to that close, that's about 16 S&P points down, and that represents about a 3.5% pullback. Okay, so essentially, in other words, what we're looking for here is if the S&P pulls back about 3.5%, this is where we would be highly inclined to buy. And we could express this trade by either simply buying the stock itself, or generally our preference is to express the trade through some sort of options position. The most simple one, of course, would be to simply buy a call. And we would buy enough time, of course, so we don't get hurt by time decay if it takes a while for the trade to work out. So we would essentially buy a call. We would probably buy a call slightly in the money, maybe the 435 strike or something like that. And that would be one way of expressing the trade. Another way of expressing this trade would be to sell a bull put spread. And at that point, then one could collect premium, but the trade would be based on the fact that we expect this bounce out of this level. And of course, if you sell a bull put spread and collect premium, if we get that bounce, the options premium on the spread, of course, is going to decline. And of course, that's what you're looking for in that kind of position. So we could express that trade in any number of ways, but it's all based on this demand zone. Okay. And if we look here, right here, I have in here the note here. Here's that demand zone. Again, it's an area of expected upward price pressure, and it's created by consolidation in the narrow range, which is what we have here. There's an exhaustion of sellers in the range, and then it's followed by an energetic bullish move as essentially the buyers ran up the price chart. And again, if we get the pullback here, that's where we're going to expect to see another round of buying there. So that's what the demand zone is. And of course, the supply zone, what we have above here is more or less the same exact thing, except on its head, of course. And that's an area of expected future downward price pressure. And again, that's created by that consolidation and then an exhaustion of buyers. Okay. And if we go back in time here, and we can see right here, okay, this was an area right here, price rallied up there. It's not the cleanest supply zone here, but it was definitely an area of supply where price came up, dropped. There was a little pullback, and then it kind of dropped out of there. And then when price returned to that region, we can see, okay, this is an area where we might expect to see another drop here. I'm not racing to short this though. Okay, so really what I'm looking for is that there are some cleaner areas of supply above, and that's really what I would be looking for here. And so if we go back in time a little further, okay, these are really the areas that I would probably be inclined to look to actually short, kind of in that 475 region, or perhaps a little below that. Okay, and this is clearly an area price consolidated and then shot down from there. Okay, so if we go back and we take this line and we move this up here, we can see that the area above, that's about 3% above, so roughly equidistant to what we were just looking at below. And then this other area is a little further up at around 4%. So areas that I would looking to short are kind of 3 and 4% above where we are now. Areas where the most immediate area where I would be looking to buy would be about 3.5% down. And so that's what I'd be looking at on the SPY. If we turn to the Qs, okay, here on the Qs, here's an area, and we were looking at the daily chart before. Right here in the 2-hour chart, there's actually an area that's down here that's about 2.5% down from where we are now. And if I quickly shoot over to the 2-hour chart here, here it is in the 2-hour chart. And so right here we can see, notice price came up from here, consolidated, and then popped from there with that gap. Okay, so that's the reason that when we look to see if we get a pullback here, this is where I would be looking to actually execute a long trade here. And so that's about 2.5% down. If we go up to what's above here, there was a clean area of supply that was right back here, and this actually goes back a long way. This actually goes back to the beginning of 2022. Okay, so this is about 15-16 months ago, in the beginning of 22 in January. Okay, but notice price came up, consolidated, and then notice it kind of dropped with a great deal of energy, a little pause, and then it kind of shot down from there. Okay, this was a clear area of supply where there was an exhaustion of buyers here. So when price returned here, and this was actually very recent, okay, so price came up here, and we actually ended up getting a kind of a nice successful trade out of that. And we ended up buying a put out of here. And over the course of a couple of days, we actually got this move, and it actually came right down almost to this area of demand here. Okay, and so this was a short trade. So now we're actually waiting for price to return to this region, and this is where we would actually be looking for a long trade here. Okay, so that's how we would express that trade out of this demand zone. If we look further down, over here, this is an area where this is kind of a sloppy area at this point. There was some demand here, okay, but this has all been spent. Okay, there's a lot of trading that's gone on in here. Price consolidated here, it went up. Price returned here twice, dug into the zone and left. So we're done with this. So the next area we would be looking to then go long out of would be this area over here. Okay, so one area that we'd be looking to go long would be this one, and then this is the next one that's down if this one would happen to fail. Okay, so at that point, if price drove through this one, then the next level down is about 6% down. Okay, so we have this one here, which is about 2.5%, and then this would obviously be another 3.5% down. But this is the next place that we would expect the price to kind of bottom out and get a bounce out of that. And so we would then, base a trade on this level. Okay, so the way we would construct a trade from here, we would kind of have look to this as to be sort of our entry point where the green line is right here. And then we would place our stop roughly about there, a bit behind, okay? A bit behind this demand zone, okay? If we had a trade over here, then this trade would look something along the lines of that, okay? And so, and of course, this is not exact. That the stop placement I just did was approximate here for the purpose of this demonstration. Obviously, we would have a more precise way of placing it, but generally, that's what the trade would look like. And then we would base an options. We could base an options trade on this entry here. Okay, so that's what the Qs look like. And if we go to the Russell 2000, here's where we are now. So here was the close on Friday here. And in fact, I'm going to go back. In fact, this level is actually based on the 2-hour chart here. So that's a little over 2% down, 4.5 Russell 2000 points down. So this is where this area that I would be inclined to buy over here. Over here, this is an area you can see it price popped here, but there's really no clear consolidation. This is more of a pivot here, and the reason for that is if you actually look at the time that the zone this level got created, this really can't be an area of demand, and that's because of the clock. Right here, if we look at this data window here, we can see that this was the end of the day. It says 1600 hours. So I'm in New York City here. So of course the market closes at 4 p.m. Eastern time. And then this green candle immediately to the right here, where I'm pointing at here, this is the next day. Okay. And so as a result, this essentially could never be an area of consolidation, because really what you had here was a gap. Okay, if you notice, so price closed here the prior day, and then it opened here the next day. That distance there, you forget the wick here. That's actually a small outside gap that occurred between here and there. Consequently, you could never have an area of consolidation, and that's a consequence of the clock. Okay, so this is really a pivot. So I'm a little wary of trading off of this, but having said that, there is an energetic move, so we will keep an eye on that. And if price would actually start to turn in this region, we could actually end up taking a trade if it kind of broke away from this zone here. And we would sort of do that on a confirmation basis. We would actually wait for price to turn around. Okay. Right here, here's a good example of a demand zone that had actually worked nicely. Notice price came down here, consolidated. Notice it rocketed out of here. And then a few days later, it came right back into here. And then we got this nice bounce. This was the basis of a good trade that we had earlier. And we kind of used this area up here as the basis for our for our taking our target here. Okay. Sadly, we didn't actually take this trade. Price returned to this region again, and in fact, this is really where the big trade occurred. Had one taken this, sadly, we didn't. In a sense, we were wrong, but I probably would have ended up doing the same thing again. Why? Because more or less, we consider the first test of a demand zone being the best test of a demand zone. Each time price returns, it's less likely to work because some of the demand has already been chewed up. And so the highest probability trade was this first time it had returned to this demand zone. This at the time, this was a fresh level when price returned here. After that, when price returns here the second time, the level is no longer fresh. But having said that, it did work. But nonetheless, that's the rule here. So, there will be times that we'll take a trade the second time, but this was not one of them. And so, of course, we can look at this in the rearview mirror and go, well, we were wrong. But I think I'm still comfortable with the trade, or I should say the lack of trade. So at any rate, where I would consider taking a trade, though, is this level right here. And then if price drove through here, I think the next long level is probably down here. And that's actually about 10% down. Now, that's the way the chart lays out now. Having said that, it's quite possible that once we get some price action going here in the next week, and if we get a bounce up here, we may end up getting another level of demand somewhere where we could trade. But as of this moment, the first area of clean demand that we have in the 2-hour chart is right here. Price rallies, consolidates, and then notice that we have a gap, and then those three very bullish candles there. So that would probably be the next area down here that I would be looking to go long out of. All right. So those are our levels there on the Russell 2000. So there you have it. So anyway, those are our trading levels. I hope you found this interesting and helpful. What I would like to leave you, though, is leave you with so in these previous charts, you've seen me talk about where we buy and sell, where we buy out of demand zones, sell out of supply zones, and those are generally areas of where institutional either distribution occurs in the case of selling, and obviously the opposite for buying. And so, again, those are areas where there's this in the demand zone, there's a sudden exhaustion of willing sellers, and that's where we buy. Supply zones, that's where there's an exhaustion of willing buyers, and that's where we expect then price to drop further. Again, I hope you found that helpful. If you did, we would be delighted to talk to you further about this and how we can use supply and demand to basically create high probability controlled risk trades, talk about trade management tactics and scaling out of trades by using opposing zones, and then also in terms of options trading, actually using this as the basis to have more efficient entry points, and also to help us actually with our strategy selection, as well as the tactics in terms of what specific strikes one should select. And so if you click on this link in our the YouTube summary, you can schedule a call with me, and I'd be delighted to talk further about this with you. So again, thank you very much for the privilege of your time. This is Mitch Firestone with Precision Trading Labs, and I will see you next time. Take care.